So open right, we do the same thing on a balance sheet. The Reserve Bank wants to push more money into the economy, more ESF into the economy, and they do so by buying securities. We said that already. How does it look on the central bank balance sheet? Let's look at the bank. So for the bank, they're selling some of their securities to the RBA. So their assets side security is going down, and they get ESF in. For the RBA, they get the security in, and their liability towards the banking sector is increasing as well. I think that's pretty straightforward. For decrease, the same thing with different signs. So I can jump over it quickly. So then we have something called liquidity facilities, two different kinds of intraday and intraday. So intra means within. So intra-Australian trade, for example, would mean trading within Australia, Melbourne with Sydney. Intraday means within the day, and within the day, banks can get free ESF from the RBA, however, as a repo. What does that mean as a repo? Basically means they can get it for free at 0 interest rates, but with a repurchasement agreement, that means in the morning, if I need the ESF, I'm selling my securities to the RBA, they give me ESF, and in the evening, they sell it back to me at exactly the same price. So in the end, it didn't cost me anything. Why do we do the repro? Just in case I'm becoming a Lehman and I'm not around in the evening. Because the RBA doesn't want to get risk on its balance sheet. So they give me the loan for free, but they have the government debt there as security. And overnight repos. So overnight repos are different. They're charging an interest rate, and the interest rate is 25 basis points above the target cash rate. And the idea here is the following. Basically, the RBA wants to have banks lending and borrowing from and to each other. So they don't really want to intervene too much in the interbank market. They don't want to become number one lender to the banks. They want to have the banks figuring things out for themselves, between themselves. And therefore, if the RBA has to step in, they charge you a premium. So it's going to be more expensive to borrow from the RBA. So your first point of call is to ask all the other banks for a loan, and only if you can't get it cheaply from them, then you run to the RBA and get a loan. And not only is it more expensive, again, it's a repo, so you have to rock up with the security, and you make an agreement. I sell you that security today, and I'm going to buy it back tomorrow. Repo. Sometimes it's also called a reverse repo. Reverse repo is just going in the other direction. So you can tell, it depends upon if you take the viewpoint of the bank or the viewpoint of the central bank. The overall arching term for these repos. This one is somewhat interesting. So it's a huge text. I'll let you read it first. So why did I bring that up there? Number one, it has all the nice keywords here. Repo, says something about deficits, and it's a little bit more than what you've learned in macroeconomics. So rolling over just means you repeat something that you've done beforehand. So for example, if I borrow $10 from you till tomorrow, rolling over means I come tomorrow to you and say, listen, can you lend it to me for one more day? That's rolling over. So we do a similar business again. So these guys are doing repos every day, and usually what happens is next day they roll it over again. So the banks actually don't really fully repay the repo, but they do a second repo just to follow on. And then it says something else there here too, that the cash position is in deficit. So cash position is just a fancy way of saying if the banking system is getting more ESF or less ESF. So it seems that there's an ESF outflow on most days out of the banking system. And that seems a bit weird, right? You might wonder why should the banks lose ESF on most days? And it's quite easy to understand once you look a little bit at details. So when we do the repo now with a bank, I'll make a simple example here, overstated, but the number's going to be easier. So we have here the banking system is selling its government securities to the RBA. Therefore, they get ESF in, ESF here as a liability for the RBA. And repo means we make an agreement that tomorrow or in a year's time or wherever I'm going to buy it back, including interest. So I buy it back usually at a higher price, let's say at 105. So I promise I'll buy it back tomorrow at 105. Tomorrow comes along, so that's the second leg now. So I have to pay now the bank, the RBA, 105. I get back my security, which is only worth 100 now, so I kind of paid interest in that sense. The security goes back from the RBA, and the RBA, of course, makes a nice profit here. They've earned the interest. But look at what happens all over here. So I received yesterday less ESF than I paid now. And that's what I mean by most days in deficit. Because just by these ESF, the RBA is earning interest all the time, and the banks have to pay interest all the time. And they have to pay their interest in ESF, with ESF, of course. So that's the reason why the banking system is kind of in the negative most of the time. What also you can see here is central banking is a fantastic business. Because how expensive is it for the central bank to finance all its ESF? How expensive is it for a central bank to get money in or to create money? Nothing. Central banks can print their own money. If central banks want to have more liabilities, they press enter on their keyboard. And the interest rate they pay on that one is usually zero. Currently, I think since 1 or 2 years, they introduced a small interest rate, the cash rate minus 25 basis points nowadays, but very, very low interest. And it's totally at their discretion. They could set it to zero too if they want to. So central banks make huge profits all the time. So that came along just after the global financial crisis. Remember, if I have too little liquidity, I ask the other banks, but remember the spreads. After the GFC, did banks trust each other? Did they lend to each other? No, right? So the interbank market dried up, spreads start shooting up. Now the central bank is worried and said, okay, you can borrow from us, just bring us the government securities and we do repos. But at the time, Australian government had very, very little debt. So there were very few of these government securities going around. And the banks had even fewer of these government securities on their books. So after a few weeks, they ran out. So they couldn't do any repos anymore. And the central bank was scratching its head. They wanted to still help the banks. And what they did is then, okay, we make a special thing here. We've got plenty of government securities on our books. We lend them to you, and then you sell them to us back. So it's kind of a trick to help them out with the collateral. That's what's meant here by security lending facility. The reason why we kept that in here is to show that after the GFC, central banks all over the world became kind of creative, right? Because the old rules that they had, they started to face really constraints there, that they couldn't help the banks enough as they wanted to under the old rules. Remember, Goldman Sachs could not be helped because as an old rule, as the investment bank, they can't get an emergency loan from the Fed. So what they did is, piece of paper, promise that you're a bank now, done. Get an emergency loan. In Australia, banks ran out of government securities. Well, we just lent them to you. Problem solved. So central banks can be somewhat flexible on these things if they really have to. Remember that the cash rate is the interest rate that comes over from the other market just between banks. The central bank is targeting a certain degree. Let's say, for example, we have a lot of demand, so we're just pushing demand here. You can imagine if lots of banks want to borrow from each other, the cash rate starts creeping up, creeping up, creeping up. So it goes up from 1.5 to 1.6, 1.7. And here the question is, now, why is it impossible that the cash rate between banks goes above 1.75? And that has something to do with the repo rate. So the repo rate is the cash rate target plus 25 basis points, 1.75. Why is it impossible that the interest rate between banks go past 1.75? And the answer is quite simple if you think of it in practical terms. So you've got two banks. They're in the interbank market arguing with each other, right? So one bank A needs $10 million till tomorrow. And they talk to bank B and say, come on, $10 million, can you lend it to me till tomorrow? And bank B says, 1.8%, I'll lend it to you. And you're bank A. Why are you're not saying yes to 1.8%? So you might, of course, say, no, I don't want 1.8%. I offer you only 1.6%. And bank B then says, nah, then I don't lend you anything. What's your outside option? What could you do? Instead of asking bank B, you could ask the central bank. Right? And the central bank is lending it to you if you have government securities for 1.75. So any bank that has still enough government securities as collateral on their books would never pay another bank more than the cash rate plus 25 basis points, because you can always get a repo loan at 1.75 from the central bank. That's the reason why it's impossible that the cash rate goes above it. Similar idea for below it. So let's say there's plenty of banks that want to lend each other money, right? There's plenty of liquidity going around, so the cash rate comes down and down and down and down. But the RBA is also saying, we pay you on our ESF account 1.25%. So if I lend to you at 1.3%, I'm happy, you might be happy too, right? But then if the cash rate keeps on dropping because there's so much liquidity around, now people are saying, well, you can give the ESF to me, but I'm going to pay you only 1.2%. Should you lend it to another bank at 1.2%? No, because the RBA is paying you 1.25% if you just leave your ESF at the RBA account. If you leave your car in the garage in that moment, you already get the 1.25%, even without getting the Uber driver driving around. You just earn something that is just sitting on your account at the central bank. That's the reason why I can't get lower, and that's the reason why we call the whole thing channel system. So the interbank interest rate is kind of arrested between the 1.75 and the 1.25, or say it's slightly different. The maximum fluctuation around the target cash rate is 25 basis points up and down. So what else do we have here? Yes. So depending on which textbook you're reading, they often focus on the quantity of money. And we have a little bit of quantity of money in here too, right? We can think of ESF supply here is a quantity of money. And in the olden days when I was a student, actually the central banks often published not the target interest rate, but the target money growth rate. So they said, we want to have money growing this year at 3%. Or we want to have money growing this year at 2%. So we want to push the supply here up by 2% or 3%. But while central banks and textbooks might have emphasized that very often, in finance and financial markets, the emphasis was always on interest rates. So for example, the central bank in Germany at the time, the Bundesbank, well, we want to have money growing by 2%. So we want to push this one 2% to the right. And they started to let money grow by 2%, but then it turns out that the interest rate dropped a lot. And then they simply changed their mind and said like, oh, let's grow it only by 1% here to keep the interest rate a bit steady. They didn't say to keep the interest rate steady, but that's what they did. Same way the other way around. Let's say the economy is growing fast and banks want to have more and more ESF, so they're demanding more central bank money. And the central bank initially said, well, we want to keep money supply somewhat steady. But now the central bank is seeing that the interest rate between banks is just rising up, and then they just increased the amount of money. So if you look at the data for Germany at the time, while the central bank says we want to target money supply growth, the actual money supply growth was all over the place, whilst the interest rate was somewhat more steady. So you can tell they were talking about money supply growth, but what they really did is they focused on the interest rates. And nowadays, central banks are perfectly open about this one. Interest rate is what they're focusing on as an intermediate tool to target inflation. Good. So watch out when they're saying money supply, money supply, money supply, especially in macroeconomics. So it's just a simplification of that idea, but in the real world, they're usually targeting interest rates and inflation and how the economy is going.